UnitedHealth Group on Thursday posted second quarter earnings that blew past estimates and raised its full-year profit outlook. The healthcare giant is working to stabilize margins by shrinking membership, exiting unprofitable contracts, and pouring $1.5 billion into artificial intelligence to streamline operations.
The sheer scale of this financial win, honestly, it's hard to overstate. In an industry that is currently getting absolutely battered by high medical costs, these guys didn't just weather the storm, they completely crushed expectations. This sets the stage for a massive operational shift that's actively reshaping the largest private insurer in the United States. Okay, let's dive right into this. The proof here is just staggering. Based on analyst surveys, Wall Street was looking for adjusted earnings per share of about $4.90. But UnitedHealth? They delivered $6.38. I mean, that is an enormous beat, and it immediately flips the entire narrative around their profitability. And the outperformance wasn't just on the bottom line either. It extended right to the top line. Analysts were expecting $110.85 billion in second quarter revenue. The actual number came in at $112.03 billion. Both their insurer side and their Optum healthcare unit topped sales estimates. These numbers were so strong they actually drove an immediate 7% pre-market jump in the stock. But the real story isn't just that they made more money. The story is the exact mechanics of how they pulled off this turnaround. So here's the actual game plan. It rests on 4 core pillars: shrinking membership, exiting unprofitable contracts, pouring $1.5 billion into AI, and finally assessing the long-term reality. Let's start with pillar number 1, shrinking membership. Now, at first glance, intentionally losing members as a strategy to make more money seems totally counterintuitive, right? But it is a really crucial part of their margin stabilization. Just look at these numbers. In the second quarter alone, UnitedHealthcare dropped 525,000 members compared to the previous quarter. And looking ahead to 2026, they're forecasting a loss of roughly 500,000 Affordable Care Act exchange members and a whopping 1.1 million Medicare Advantage members. Why do they do this? Well, skyrocketing healthcare costs forced insurers to raise premiums. That affordability pressure naturally squeezes consumers out and shrinks enrollment. But, and here's the kicker, because the pricing is higher, that extra cash completely offsets the drop in members, keeping their revenue totally stable. Which brings us seamlessly to pillar 2, exiting unprofitable contracts. Sometimes you just have to cut the dead weight to fix your core operational metrics. To really grasp this, you need to understand the medical benefit ratio, or MBR. It's basically a measure, well, actually, it's a direct measure of total medical expenses paid out relative to the premiums they collect. The ultimate goal for an insurer is a lower ratio here. A lower MBR simply means the company collected more in cash than it paid out in benefits. Lower MBR equals higher profitability. And this is exactly where that ruthless restructuring pays off. A year ago, in Q2 2023, that ratio sat at 89.4%. But looking at Q 2024, we see a massive drop down to 86.7%. To put that into perspective, analysts only expected it to dip to 88.5%. UnitedHealth blew right past that estimate, proving they have a significantly tighter grip on controlling medical costs compared to what they're bringing in. Moving on to pillar 3. Frankly, this is the most technologically fascinating part of their whole strategy, pouring massive amounts of money into AI to streamline operations. $1.5 billion. Take a second and just absorb that figure. That is the exact capital UnitedHealth has deployed directly into artificial intelligence. We aren't talking about a side experiment here. This is a foundational operational shift designed to completely overhaul their efficiency. So what is all that money actually doing? Think of the AI as a massive digital filter. It speeds up heavily bureaucratic processes like prior authorizations. It improves payment accuracy by automatically flagging potential fraud, waste, and abuse. But crucially, and CFO Wayne DeVete was extremely specific about this, these AI tools do not determine whether a patient's care is denied. The AI is deployed strictly to slash administrative costs and boost efficiency, which translates into what DeVete describes as strong earnings. Now, what's really interesting here is the broader context. Because despite this massive financial flex, the reality is that the rest of the insurance industry is still facing some severe systemic struggles. Insurers are currently getting pinched by a whole wave of elevated costs. You've got an influx of people finally getting the care they delayed during the pandemic. You have the heavy financial impact of high-cost specialty drugs like GLP-1s. And on top of those medical costs, there's regulatory pressure. It's been about a year since UnitedHealth revealed it's facing a DOJ investigation over its Medicare billing practices. The company stated it has no new updates on that front, but continues to be supportive of the probe.
This quote from CFO Wayne David perfectly grounds the whole situation. He says, "These results are not a reflection of trend bending or coming under control, but rather our efforts to start pushing down what is already an elevated number. Management is being very transparent that this is a multi-year journey. Underlying medical costs are still extremely high compared to historical levels. UnitedHealth is just managing them much, much more aggressively than anyone expected."
And that aggressive management is exactly why they were able to raise their outlook. They are now projecting 2026 adjusted earnings of $19.50 to $20 per share. That's up from their previous outlook of $18.25. They're also holding steady on their full-year revenue guidance of over $439 billion, with DeVitt noting he actually expects the company to do better than that. This is the undeniable impact of a ruthless efficiency drive. So it all boils down to this. UnitedHealth has proven they can architect a highly profitable turnaround by shrinking their base, exiting bad contracts, and deploying AI at a massive scale. But it leaves us with an incredibly complex picture for the future. With AI driving down operational costs for insurers, while higher healthcare costs continue to force consumer premiums up, who ultimately wins in the next era of healthcare?